Speaking of Alternatives with Keshav Rajagopalan, Managing Director, Head of Product and Strategy at PGIM. Investment-grade private placements have an important role to play in a well-diversified fixed income portfolio, providing diversification, attractive yield potential, and enhanced protection against defaults. Keshav delves into private placements with Mike Campion, Managing Director and Portfolio Manager for PGIM Private Credit.
Welcome to Speaking of Alternatives, the podcast where we dig into the many layers of the alternatives landscape. Today, we're going to explore investment-grade private placements with Mike Campion, my colleague and friend, who's a managing director and portfolio manager in our private credit business at PGIM, specifically focusing on our private placement platform. Mike, welcome to the show.
Great to be here, Keshav. Thanks.
Before we jump in, we always like to get to know the person behind the investment capability. So I want to start with you, Mike. Let's find a little bit more about yourself. What brought you to PGIM? What's kept you here? What keeps you interested in what you do today?
Wow, what brought me to PGIM? You're really testing my memory, Keshav, because it was a long time ago. I actually celebrated my 28th work anniversary here at PGIM just 2 weeks ago.
Happy anniversary.
Thank you. Appreciate that. Others have heard me say this before too, but I guess I either like what I'm doing or I'm unhireable. I'm not sure which it is, but one of those two. Private credit is really interesting to me, kind of always has been. I think because I have been here for so long, I've really seen the market itself and then our approach to it just evolve a lot over time. We have 15 offices around the world now. Corporate credit, infrastructure credit, renewables, credit tenant leases. I've seen our presence outside the U.S. grow to be almost equal what it is in the U.S. when you think about what we're actually doing today in current investment activity. And then also my focus is more on the investor side, and we have investors all over the world now too. So it's super interesting for me to hear all the different global perspectives and then take a step back and think about the family-owned, multi-generational business that we're providing capital to. And it almost sounds a little corny, but I always like driving down the highway, seeing how many trucks or billboards have names of companies we've invested in. It's just still cool to me and resonates. Today, I would say there's never really been more investor interest in private credit, so that's pretty fun too. And then I get to do fun things like this with you today.
Well, it's been a lot of fun working with you in many different aspects. You started with something, right? Private credit is obviously just booming. It's a buzzword, whether you go to industry conferences, you read the industry rags or newspapers at large. Tell me a little bit about what private placements are in the context of private credit, and also a little bit how we think about it as PGIM.
Yeah, sure. It feels like a simple question, but it's a great one. Private credit means different things to different people. I feel like there's always something in the finance world, but this is the latest finance classification that doesn't really have one clear definition. So the most important thing to do right off the bat is make sure everybody's speaking the same language. You have to remember non-traded debt or private credit really isn't new. Insurance companies and banks have been providing capital to people and companies for more than 100 years. And so you think about private credit, generally speaking, certainly, as you said, become much more mainstream for most institutional investors, and there's likely room for multiple flavors of private credit in portfolios today. But I think for the most part, most investors don't really consider it to be a niche alternative anymore. It's really just an extension of fixed income, and they're simply viewing private credit as a diversifier from other fixed income assets like public corporates, and it's an allocation that can provide yield pickup and some structural protections at the same time. I've heard some of our investors describe private credit as their income engine, or they would view it as a yield stabilizer. So I think investors think about private credit today as, again, part of their broader fixed income allocation. And they're really just looking for diversification across names, sectors, geographies, and private credit can really do all of those things. Just think about different investors will have different needs. And you think about insurance companies or pension plans, maybe they're looking for long duration, but with some downside protection. That's really where investment-grade private placements really shine. Or maybe it's somebody looking for more yield and duration isn't as important, and that could probably be filled by direct lending or even mezzanine. So the main takeaway with private credit overall is it can serve many purposes, now however you slice it, but it feels like a much more permanent piece of capital as opposed to cyclical or opportunistic at this point.
Very helpful framing. And tell me a little bit about how PGIM's platform works in especially the private placement space and what differentiates us in terms of longevity, but how, more importantly, we think about it from an investment perspective.
It's pretty simple. We are bottoms-up fundamental credit shop, and I think our mantra is really about direct origination, which means we're working directly with issuers as much as we can. We get to know the local market. We get to know the senior management team, ownership over years and sometimes decades. So we're in this for the long run, but it's all about, again, bottoms-up fundamental credit analysis and relative value versus public comps. We're not really trying to overweight or underweight certain sectors or play on certain parts of the curve. It's all about relative value versus comps, bottoms up, individual deal. And we have 15 offices around the world. And I would say Minneapolis is doing the same thing as Madrid. Our approach is the same regardless of where we are. And that's resonated for us, for our colleagues, as well as our investors over long periods.
And you pointed to one of the things that has kept you at PGIM and keeps you interested today is the real economy field, right? You're driving down the highway and you see a business that we've lent to on a repeat basis because of that direct origination model.
That's 100% right, Keshav. In any given year, probably about 2/3 of our volume comes on that direct or bilateral basis. Half of those issuers are repeat issuers. So we have plenty of companies that we've been investing with and have gotten to know literally over decades.
While private placements have been part of the fixed income space for decades, their appeal is growing for today's investors, particularly those who seek broader diversification and attractive risk-adjusted returns.
So bring us to the here and now. What is the case, if you can in a nutshell say, why should an investor be thinking about an allocation to investment-grade private placements today? I know you mentioned the longer-running themes, duration, diversifier, yield stabilizer, you use those words, but what's the thesis today?
I think I'm going to cheat a little bit. I would say my answer is that an allocation of private placements always makes sense, not just today. Maybe I'm a little biased on that, but simplistically, I would say all we're really doing is monetizing liquidity. We're not taking incremental risk. So privates provide better buy-in yields versus comparable publics. They typically come with additional downside protection through financial covenants. That historically has led to better loss experience over time through all kinds of market cycles. Simplistically, a BBB private placement acts much more like a single A rated public. And all that's true in any cycle. Like all those things I just mentioned aren't really specific to any point in the cycle. But that said, when we look at where we are today, we continue to see attractive buy-in spreads when compared to public comps. And then when you think about how much public spreads have tightened of late, you could argue that the incremental spread pickup is even of more value today. And that relative value is of utmost importance today and really makes up even more of the credit spread or the underlying yield that we're generating today. To kind of wrap the elevator pitch, if you don't need immediate 100% liquidity from trading, why not get the incremental yield and diversification without changing your risk profile? In any market cycle, I think that makes a lot of sense for investors.
And certainly for long-term investors, it comes back to risk-adjusted return, right? So that's the thesis when you think about the diversification. And then there are other elements, as you mentioned, on duration and other use cases here that we'll talk a little bit about in just a second. Let's unpack a headline. It just helps contextualize this for our audience. So I was reading something from IPE focused on institutional investors in Europe. And no surprise, it talks about the increasing allocation to private credit. But there are some concerns about what's happening in the debt space, which we'll talk about in terms of headwinds. But when you kind of stepping back, talk to investors around the world, where are you seeing interest in private placements vis-a-vis investors in the US or Europe, Asia? What's the theme from a conversation perspective with capital providers?
Yeah, sure. There's a lot there. We touched on this a little bit a minute ago, but all types of private credit. And I would say they're not all created equally. I would say that most of the headlines people are seeing today, when you think about First Brands, Tricolor, other names like that that have been in the news of late, they've definitely centered around the direct lending market. I think most folks listening to this probably know bank regs changed. There's been a huge influx of institutional capital flowing into the direct lending market for several years now. And we're super active in that space and have a great platform. But what I'm focused on, as you know, and as you said up front, is really investment grade private placements. And I would say investment grade private placement market has seemingly kind of always been here, primarily driven by insurance company investors and pension plans. At PGIM, we've been doing this for so long. We have some support that goes back to 1956. And then we also have a commingled fund that I help look after for U.S. pension plans. It's been around since 1976. That's still going strong today. So we've been in the market for at least 70 years and managing money for others for over 50. So none of this is new to us. But I think more specific to your questions, like where are we seeing the interest for investment grade? It's really everywhere. To be honest, I mentioned before, I don't think I've ever been more popular than I am today.
Private placements can play an important role in the portfolios of a variety of institutions globally, from insurance firms to traditional pension plans to employer-sponsored retirement plans.
You think about traditional life insurance companies or non-life who are investing to support their annuity and retirement businesses, or PRT, pension risk transfer, or reinsurance businesses. All of those investment grade is top of mind. And then you shift over to the pension world, and we're seeing continued interest from DB plans. And then more recently, we've really seen a pickup in interest from DC plans. They're becoming more and more open to investing in private assets, whether in a stable value or target date fund context. So really across the board, and I would say all of this is true, whether you're talking about the US, Western Europe, or even Asia, Japan, and Singapore in particular. I think all of those markets we're seeing interest from all of those investor types I just went through. So, I mean, there's really no shortage of investment opportunities and investor interest, given all the different private companies there are around the globe. I think the key to success here long term is we're kind of charged with looking in every nook and cranny to find any opportunity we can. But more importantly, you need to know which ones are the ones you want to pursue. I mean, a manager or an investor's ability to cast a wide net is super important, but we really think there's lots of room to run in terms of sourcing deal flow and providing good risk-adjusted returns. Even though there's a lot of headlines, it definitely feels like for investment grade in particular, it's full speed ahead everywhere, I would say.
Yeah, it definitely sounds like a lot of tailwinds, both on the investor interest, but then the opportunity set. What are other tailwinds you're focused on? We talked a little bit about the portfolio construction aspect, but what are some other themes that are emerging either from an asset class perspective or from an origination perspective?
It's interesting as we've talked about private credit not having a super clean definition, but it's really allowed us to have more and more conversations with investors all over the world. Private credit is almost ubiquitous at this point, and that just, again, means more conversations with prospects and investors who are interested in hearing more about the asset class. It's funny, we wrote 10, 15 years ago a white paper on investment-grade privates, and the title was The Hidden Gem of Fixed Income. I don't think it's hidden anymore. And I just think the general interest and acceptance of privates as being a more permanent part of an allocation or a permanent part of someone's capital structure, their asset allocation, is just huge for us. And the fact that we have this local presence, we always think about it as a global but local. And I think just as more and more information gets out there in the public domain, you get less resistance, I think, on the issuer side, but on the investor side. And people understand that public and private debt, all of it can make sense depending on what you're trying to do, whether you're an investor or an issuer.
What are some of the challenges? You're an investor. What are some of the things that they should be thinking about in terms of potential risks?
Fair question. There may even be some recency bias in my answer here, but I would say there's definitely a level of uncertainty in the markets today. You think about whether that's just rate-driven, geopolitical risks, impact from tariffs. We're definitely seeing more companies struggle with the planning around all that recent uncertainty and then changes following the pandemic. Even though we're several years out, if you just think back a few years, a lot of companies went through a roller coaster of demand, and then that was coupled with meaningful supply chain challenges. And now they're trying to reimagine supply chains and come up with an accurate read of what consumer demand is as behaviors have changed a lot since the pandemic. And all this while balancing some of those macro factors I just mentioned. This is where experience comes into play. A lot of folks can jump into an asset class or jump into a space and close some deals. But when there's challenges, that's where you see who really did their homework. Structure doesn't save you from bad underwriting. You're either protected or you're not. And that's what everybody in our organization loses their sleep on is, are we protecting the downside? So I think portfolios are performing really well from a credit perspective. In particular, investment grade is in very good shape. And it's amazing how resilient the markets have been. But there's pockets of challenge on the issuer side, and then we're managing those credits for our investors. So that's really where we're spending a lot of our time today, is managing those and watching for themes and trends that may be coming from a credit perspective.
An investment strategy that effectively blends both public and private credit can tap into the best of both worlds, extending diversification and reducing exposure to overall portfolio risk.
So now pivoting, we'd like to hear questions from the floor from our distribution teams who have their ears to the ground. So a couple that have been posed to me that I just wanted to relay and get your thoughts on. One is the well-discussed theme of the blurring of public and private credit. We touched on this a little bit as you commented in the beginning on what's the portfolio construction aspect of putting private placements in a portfolio, the extension of fixed income. But talk to me about how the blurring may look on the financing side. We're a large credit shop, over $1 trillion in assets overall, But there's actually a really interesting interplay between our public and private side, especially as we bring those platforms closer together. How does that play out on the actual financing side of companies? If you think about companies looking for access to capital and accessing then public markets as well as potentially private markets.
Yeah, sure. I just feel like more and more this is becoming accepted, but it's important to reiterate that the moniker of private in and of itself doesn't necessarily imply greater risk. And I think that's the hurdle that we've gotten over. But I 100% agree. The blurring of the lines is definitely here to stay. I think you just say credit is credit, whether it's publicly traded or not. And I think public and privates work together in portfolios, but also our perspective is skewed by what we're doing here at PGIM. But I think the bringing together of the public and private units and credit expertise opens us up to a whole new world of financing opportunities. We've seen more of these Intel and Meta deals, and data centers are all the rage today. And being able to provide all different types of capital to an issuer, I think, really puts you at the forefront and being able to provide unique opportunities for investors. The good thing is we're not out there with a blunt instrument saying, here's my piece of capital, make it work. What you can really do is frame the right type of capital for what the needs are on the issuer side. And then there's always investors that may want all that or pieces of it. So I think being able to do all of it together, again, bringing together the credit expertise, we have an incredible public research team. We have access to over 1,000 private companies that we have in our portfolio today. That kind of information isn't publicly available, so you're providing a lot of the public sector expertise. And then we have a really strong asset-backed team. I think you had Edwin on here a couple of podcasts ago on the structuring side. So you bring together all of that. It really provides so many different options to issuers. That just means there's more opportunities for investors as well.
That's exactly right. As I'm talking to clients in the marketplace, hearing the financing side is equally important from a portfolio construction perspective. There's all the merits that we've talked about and one can think through. But when you think about the opportunity set on the financing side, bringing that all together in-house is a really, really powerful engine with a lot of synergies.
An attractive aspect of private placements for insurance companies is how well they serve in asset liability matching. With liability timelines measured in decades rather than months or years, these and other institutional investors can take advantage of the benefits of private placements with little concern for downside risks such as lower liquidity.
Coming to maybe a next question, I'm always interested in this given where I spend a lot of my time is insurance. You mentioned PGIM has been in the private credit, private placements market for decades, well over 50 years now. PGIM has some longevity in the space as the tie to our insurance parent, Prudential. But why do insurance companies like allocations to private placement? What's their use case?
You're 100% right. I mean, privates have been a staple for insurance companies for a really, really long time. And I think it makes sense for all the reasons we mentioned: yield enhancement, diversification, really strong loss given default track record. But it's also just a great liability match for insurers. So if you think about these deals, investment grade private placements tend to be longer dated fixed rate securities. You commonly see both amortizing and bullets. So there's lots of tenor options available where you're basically matching fixed rate income generating assets with an existing book of insurance product liabilities. The diversification piece really is important here too, though. Having new names and different sector exposure allows insurers to have less reliance on traditional public corporates. And then we're sourcing both corporates and infrastructure related paper. In certain jurisdictions, infrastructure can get better Solvency II capital treatment. So there's lots of different reasons why privates make sense as an asset class. I work really closely with the talented CIO team here at Pru, and I've often heard sometimes insurance CIOs feel like they have to make asset allocation and investment decisions with both hands tied behind their back because of all the different decisions that are driven by much more than straight economic or total return. Capital considerations are very important for insurers, hedge accounting, the list goes on, and privates check a lot of the boxes needed for insurance companies. So they usually find their way onto the balance sheets. And I think that the market's evolving too, more so down in the risk spectrum as opposed to in investment grade. But you think about rated feeder structures and things that can help from a capital efficiency standpoint. Even though folks will think about maybe investment grade or insurance investing and those types of things as a little sleepier, they are evolving and can get very complex and creative. But I think private placements are here to stay for insurance companies. Maybe just the format will continue to evolve.
I agree. I think it's a really interesting portfolio allocation for an insurer and provides a lot of different enhancements to sit alongside a public exposure. Final question from the floor. We touched on this a little bit earlier. Let's dive a little deeper into kind of the structuring and the covenants here. there is some unease in private credit markets. One, because of the amount of money that has come into the space, but two, where we are in the cycle and concern about underwriting standards. So you mentioned we're a bottoms-up credit shop. But in addition to that, how do we think about the structuring, which isn't the end-all be-all, but obviously an important component as you think about mitigating losses and the overall loss experience leading to alpha. So how should investors think about that?
A great question. And I hate to sound like a broken record, but again, just have to start with very big difference between investment grade, other private credit that maybe is further down the risk spectrum. Certainly, there's greater pockets of risk in private credit today, but investment grade really, there's talk about whether there's a bubble, those types of things. I would say investment grade's not even sniffing any kind of bubble territory at all. These are typically large, well-established, well-capitalized companies with conservative balance sheets, very reasonable leverage levels, all that good stuff. But you also mentioned covenants. You see financial covenants in these deals, and that's where we spend a ton of time when we're underwriting these credits. Some investors and managers are going to have different approaches for what they can and cannot live with in terms of protecting the downside. It's something that we really don't give up ground on in terms of terms and covenants. We'd much prefer to give up a few basis points of yield to make sure that we have the right protections in place. I think that's really where you earn your keep with investors over a long periods of time. I'll steal a line from my friend and colleague, Brian Thomas, who I think you had on your last podcast, but I've heard him say numerous times, it's simple. We're renting the money, so we want to make sure we get it back. That's the most important thing. It's not eking out an extra 2-3 basis points. It's making sure you have the right protections in place from day one. You don't want to try to be negotiating these things after there's a problem, right? The whole point of covenants is to protect you and get ahead of problems. So we spend a lot of time up front on terms and covenants because the credit experience is a key driver to long-term outperformance. The initial buy-in spread advantage is easily understood, but better loss given default experience is a clear differentiator as well. I mean, if you have the right covenant package, you can have the ability to work with an issuer to avoid problems. You can reprice a deal to get additional compensation for a change in risk down the road. You have embedded risk event protection or reinvestment risk protections, and recovery rates are substantially higher than if you looked at a universe of public corporates. All that resonates over long periods of time and is held true through all different kinds of cycles. It also helps to have a great workout team. I think Paul Prosek here at PGIM is considered one of the best in the industry, and we're pretty proud of that as well. Again, you think about default rates in investment grade historically been low. I really don't expect that to change. A lot of investors in this space do have long memories, and I think are concerned around that. But from my perspective, one of the keys to this is being able to cast a wide net for the opportunities you're looking for and having the ability to pass on the deals that you don't like the terms. You need to meet the market on price, but we do not give on terms. There's just not enough cushion in this world where you're in investment grade and not much higher yielding parts of the market.
Mike, thanks for a really interesting conversation. We covered a lot on the broad investment-grade private placements landscape, but also how PGIM thinks about it. 3 takeaways for me. I distill it down and boil it down to 3 Ds here. One is direct origination. I think there's something to be said about the model that we employ, which really allows us to source differentiated deals with that direct access. And as you mentioned, a lot of repeat borrowers and clients on the borrowing side that we're really proud of. The second D would be diversification. We talk a little bit about how IG private placements can sit alongside a public credit allocation, and it is for that diversification play around exposures to different sectors, different companies. And then the third D is what we just ended with, which is defaults, but more about how you mitigate defaults around things like terms, covenants, how to think about workouts, because at the end of the day, you've got to get the proper underwriting on the way in, but also have to think about how on the way out or as you hold the credit, how things are managed, because at the end of the day, the investor experience is also about the loss experience and that return of principal you talk about. Mike, thanks a lot for a terrific conversation. I really enjoyed it, and thanks for providing your thoughts.
Thank you, Keshav. Yeah, it's great. And I think I'm going to borrow the 3 Ds. I like that. Thanks.
Thanks so much for tuning in. Join us on our next episode where we'll be discussing private credit secondaries with my colleague Alex Stewart on Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2026. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.